right, Ladi, over to you.
Yeah, so for the global economy now, see Walt Disney Company have announced a major leadership shift, naming longtime executive Josh D'Amaro as its next chief executive officer effective March 18, 2026. D'Amaro, who currently leads Disney's highly profitable experiences division, will succeed Bob Iger, the architect of some of the company's biggest strategic moves over the past 2 decades. Iger will transition into a senior advisory role and remain on Disney's board through the end of the year before retiring. Alongside this change, Dan Walden has been appointed president and chief creative officer as Disney enters a new era of growth and transformation. And straight to my conversation now, investors around the world are increasingly positioning at this time for a steeper U.S. Treasury yield curve amid shifting expectations about global monetary policy, with Kevin Walsh now expected to become the next Fed chair. How's all of this going to impact the global economy and interest rates? Joining me for this conversation now, we have Isaac Marshall, senior investor at TLG Capital. Great to have you on the show, Isaac.
Hey, Lottie, how you doing? Great to see you.
Fantastic, great to see you. So, definitely right now, everyone's expecting Kevin Walsh to be the next Fed chair. And, the news highlights investors, ramping up bets on a steeper yield curve. What specific market signals are you seeing that explain this shift in positioning?
100%. I mean, look, so if you think about it, from the financial crisis, the Fed basically built up an enormous balance sheet of treasuries. So today, the Fed's balance sheet sits at about 6.6 trillion. So roughly, you have kind of a third of the economy of the United States wrapped up in the balance sheet of the Fed. And one of the things that has been the central focus of Kevin Walsh is him making the argument that, listen, by having the Fed soak up all that liquidity, we have actually crowded out the market-making function. So, I mean, since 2008, the bank participation in issuance and auctions has radically declined, and that's, of course, because of Dodd-Frank. But that slack was never picked up by the private sector. You never saw other funds, whether they be hedge funds or institutional investors, coming to pick up that slack because it was all gobbled up by the Fed. And so a centerpiece of his argument is unwinding that balance sheet. Now, the counterintuitive thing is that while intuitively, if you have selling pressure on that 6.6 trillion balance sheet, that's going to drive prices down and yields up in the short term. But what's interesting is he argues that actually the long run inflation should come down and long run rates should come down as a consequence of this move because of more market efficiency in the process.
So do you think institutional investors are behaving, differently from retail investors here that are going more for the long-term instruments?
Well, so I think, look, where a lot of folks have been getting in is both on the retail and the institutional side. Obviously, you've seen gold and silver explode in price. And the primary reason for that is because people were beginning to have the concern of, oh my God, is the dollar just going to keep sliding? Are we going to see continued depreciation of US dollar? Are we going to see continued potentially inflationary policies like tariffs and all that kind of jazz? And I think Kevin Walsh is a great, is a symbol of stability to some degree in that he is believed to have very high credibility with respect to Federal Reserve policy. And that's why you saw gold and silver collapse. So that 25% fall in gold prices that you saw, that's the inverse of that is basically a bet on dollar stability, moderate inflation expectations, and credible central bank policy. So I think, that's sort of where both institutional and retail investors are trading in the direction of.
Right, and looking at directions now, what risk do you see if the Fed's actions, diverge from the current market expectations?
So I think that right now, what Kevin Walsh is kind of expected to do, I mean, keep in mind, he's obviously just one vote on the Monetary Policy Committee. So, but at the same time, his thinking will no doubt influence the direction of the institution. And I think the biggest direction is going to be this unwinding of the Fed's balance sheet. So oftentimes people talk about monetary policy just in terms of the policy rate. But actually, the Fed also has this tool, which is quantitative easing and quantitative tightening, which is unwinding or buying new treasuries at auction. If you have a situation where more and more market participation is encouraged in the purchase of new treasuries issued at auction because the Fed steps back, if that encourages the participation, because we saw at the last auction, it was one of the lowest participations in a Fed auction that we've ever seen. So if you can reignite participation in Fed auctions and in rates market making, that has a really positive impact on liquidity premia, which in turn could offset the impact of, in the short term at least, of pushing rates higher just because of selling pressure on the long end of the curve. So I think that to me is like the main impact here. Is in a nutshell, I think the market perceives this as credible for U.S. Federal Reserve policymaking going forward, and I think it's probably a positive indicator for the dollar and a positive indicator for USD denominated assets.
Right. All right. I guess countdown. At this point, we'll see if he's as hawkish as they say, or maybe he turns dovish. Thank you so much, Isaac Marshall, senior analyst at TLG Capital. Thank you.
Thank you so much, Lud.
Actually, senior investor. All right, so there you have it. Those are the top stories right there, and the global economy. I'll hand things over back to Edie.